In February 2022, Russia invaded Ukraine, and within weeks the cost structure of the global economy permanently changed. The United States, the European Union, and their allies responded by weaponizing energy, trade, and debt markets instead of fighting a direct war. You are still paying for that decision every time you pay for electricity, food, rent, or interest, and the largest costs have not even arrived yet. The war in Ukraine was never just a military conflict, it was a financial event from the very beginning. It was funded through balance sheets, sustained through sanctions, and absorbed through debt rather than taxes. That choice matters more than the battlefield. Energy was the first and most important lever. Before the war, Europe built its entire industrial model on cheap, stable Russian gas. Germany, Italy, Austria, and much of Eastern Europe relied on it not as a supplement, but as a foundation for manufacturing, heating, and power generation. This was not ignorance. It was a deliberate trade-off, cheap energy in exchange for geopolitical exposure. When the invasion began and sanctions followed, gas flows were disrupted, pipelines were shut, and markets repriced immediately. European natural gas prices did not rise gradually, they reset, electricity prices followed, and industrial producers faced costs that made entire factories uneconomical overnight. Long pause. This was not inflation in the traditional sense, it was a structural repricing of energy security. Governments stepped in to prevent collapse. Germany announced hundreds of billions of euros in energy support, price caps, and corporate bailouts. France capped electricity prices and compensated utilities, and the United Kingdom subsidized household energy bills through government-backed guarantees. None of this was paid for with savings, it was financed with debt. Europe chose to socialize the energy shock instead of allowing immediate economic contraction that avoided short-term political instability, but it transferred the cost forward in time. The United States played a different role. American liquefied natural gas exports to Europe surged, U.S. energy producers sold at global prices instead of domestic ones, and the dollar strengthened as capital flowed toward perceived safety and higher yields. The war redirected energy dependence away from Russia and toward the United States and its allies. It did not make energy cheaper, it made energy strategic, scarcer, and more expensive by design. Food was the second shock. Ukraine and Russia together represented a major share of global wheat, corn, sunflower oil, and fertilizer exports. Disruptions hit emerging markets first, particularly North Africa, the Middle East, and parts of Asia. Food prices rose sharply, governments subsidized again, and debt expanded again. This layered food inflation on top of energy inflation and post-COVID stimulus. For poorer countries, this was not an inconvenience. It was a balance of payments crisis. For richer countries, it was another justification for fiscal intervention. Then came the cost most people still underestimate: debt. War financing did not appear as a single transparent line item. It was spread across energy subsidies, military aid packages, reconstruction pledges, refugee support, and central bank accommodation. At the same time, interest rates began to rise. This combination is toxic. Governments increased borrowing precisely as the cost of borrowing increased. Servicing this new debt became more expensive almost immediately. This is where the war's financial damage compounds. Even if fighting slows, even if front lines freeze, even if headlines move on, the financial architecture created by the war does not unwind. Energy systems were rebuilt at higher cost, supply chains were duplicated for security instead of efficiency, trade routes were lengthened, and risk premiums were embedded into contracts. These costs do not disappear, they embed permanently. Europe now operates with structurally higher energy prices than before the war. Emerging markets face higher food and fertilizer costs, governments carry larger debt loads, and central banks operate with less flexibility. The war accelerated fragmentation. Global trade moved away from efficiency and toward alignment. Cheap inputs were replaced by secure inputs, and secure inputs cost more. This is why inflation pressures persist even when demand weakens, and why prices do not fall the way people expect. The financial system responded predictably. Energy producers benefited, defense contractors benefited, commodity exporters benefited, and shipping and logistics firms benefited. Consumers paid higher prices. Governments absorbed losses through borrowing, and future taxpayers inherited the bill. This is the part most people miss. Wars do their worst financial damage after the fighting slows, not during the peak of violence. During war, costs are justified as emergencies. After war, those costs become structural. Subsidies become permanent programs, debt rolls forward, interest compounds, and currencies adjust. This creates a long tail of financial pressure that lasts years or decades. Now consider the divergence that followed. The United States emerged as an energy exporter with pricing power. Europe emerged as an energy importer with reduced flexibility. U.S. firms benefited from higher margins, U.S. capital markets absorbed shocks more easily, and the dollar strengthened, increasing America's ability to import inflation rather than suffer it. Europe faced the opposite dynamic. Higher energy costs reduced industrial competitiveness, fiscal deficits widened, and the euro weakened intermittently, increasing import costs. This imbalance is not temporary, it is structural. Europe cannot easily return to its pre-war energy model. The infrastructure is gone, the political consensus has shifted, and the cost base has changed. This is why deindustrialization risk is now openly discussed in Germany and elsewhere. The war changed incentives across the system. Governments learned they can fund massive shocks through debt and monetary accommodation, energy producers learned scarcity increases leverage, and defense industries learned geopolitical tension guarantees demand. None of these actors are incentivized to return to the pre-war cost structure. This leads to two possible paths. If the current order holds, energy remains expensive, food remains volatile, and debt service absorbs a growing share of government budgets, growth slows, inequality widens, and inflation becomes a management problem instead of a target. If the order fragments further, regional blocs harden, trade becomes political, capital controls expand, and currency volatility increases. In both cases, the war's financial consequences outlast the war itself. Understanding this changes how you should position financially. First, stop expecting energy prices to return to pre-2022 norms. That era ended. Second, be cautious with long-duration sovereign debt from countries that absorbed war costs through borrowing. Higher rates and larger deficits create structural pressure on bond prices. Third, recognize that food and commodity volatility is now a permanent feature. Exposure to producers matters more than exposure to consumers. Fourth, understand that currencies tied to energy import dependence face long-term headwinds. Energy independence is now a monetary variable. Fifth, stop assuming wars end financially when shooting stops. The bill arrives afterward. The Ukraine war is slowing, the financial damage is just beginning.